All right, if you've ever looked at a financial chart, you've definitely seen them. You know those squiggly lines of a moving average, or the colorful bands of the RSI. They're pretty much the most common tools in any trader's toolbox. But what if I told you there's a huge paradox right at the heart of them? One that pits academic theory against trillions of dollars in real-world trades.
And this, right here, is the central mystery. On one side, you have the PhDs and the academics who've run the numbers. Their studies basically say these things are worthless. They're just lagging echoes of what's already happened. And yet, trillions of dollars are sloshing around the markets every single day based on signals from these very tools. So, what gives? How can both of these things possibly be true?
So that brings us right to Section 1, the indicator paradox. We're going to really dig into this fundamental conflict, this showdown between the clean, neat world of academic theory and the messy, high-stakes, brutal reality of the trading floor.
I mean, the contrast is it's wild when you lay it out. The academics say, look, it's just math based on old prices, it's useless, it gives you no real edge, no alpha. But then you look at reality. These things are on every single trading platform you can imagine. They've been wildly popular for decades. Clearly, something just doesn't add up.
This leads us perfectly into our second section, a flawed crystal ball. Let's talk about the way most traders, and maybe this is how you learned too, are taught to use these indicators, and exactly where that logic starts to completely fall apart.
The logic seems so simple and clean, right? Step 1, you see a signal. Let's say the RSI, the Relative Strength Index, drops below 30. That's the textbook oversold signal. Step 2, your brain immediately goes, aha, this thing is due for a bounce. And so, step 3, you act. You place that buy order. It's a very neat, predictive, if this happens, then that happens. And you know what? This works great. You feel like a genius. Until the one time it just catastrophically doesn't. That oversold stock just keeps getting more and more oversold, blowing right through your entry point and vaporizing your stop loss. That's the moment when the academic's critique feels painfully real. It's why so many traders just throw their hands up and dismiss these tools completely. But they're missing the real story.
And that brings us to Section 3, which is really the big reframe of this whole explainer. What if indicators aren't supposed to be a crystal ball at all? What if there's something else entirely? What if they're the market's secret map? And to get our heads around this, we need to bring in a huge idea from the legendary investor George Soros.
So Soros's big theory is called reflexivity. Now, it sounds complicated, but the core idea is pretty straightforward. In financial markets, what people think and what is real are not two separate things. Market participants don't just observe what's happening. Their actions, based on their beliefs, actually feed back into the market and change the reality they were just looking at. It's a continuous, unbreakable feedback loop.
Let me show you how this plays out in the real world. Imagine a stock is falling towards its 200-day moving average, one of the most watched indicators on the planet. First, a huge number of traders all observe this exact same level. Second, because they all believe it's a support line, a critical mass of them act on that belief and place buy orders right there. Third, and this is the magic part, that massive wave of collective buying creates the very support they were all expecting to find. You see, the indicator didn't predict the bounce, it coordinated it. This connects to a really cool concept from game theory called a Schelling point. So picture this, you and a friend need to meet up in New York City tomorrow, but you have zero way to communicate, no phone, no email, nothing. Where would you go? Well, most people end up saying something like Grand Central Station at noon. Why? It's not the right answer, it's just the obvious one. It's a common focal point that people gravitate towards. That is a Schelling point.
And that right there is the true function of technical indicators. They aren't magical predictors of the future, they are the market's Schelling points. In a massive, decentralized market with millions of traders who can't talk to each other, that 200-day moving average or that RSI level of 30 becomes their grand central station. It's the obvious place where everyone implicitly agrees to meet up and act without ever saying a word.
Okay, so this all makes sense, but it leads to a darker question. If indicators are just a map of where the crowd is likely to gather, what happens when the really sophisticated players get a copy of that same map? Well, that takes us to Section 4. This is where it gets interesting, because they start hunting the herd's money.
Just look at this breakdown. A retail trader sees that 200-day moving average and thinks, that's a hard line of support. I'll buy at the line and put my safety net, my stop loss, just a little bit below it. But an institution? They see that exact same line, and they don't see support. They see a pain point. They see a big, juicy, predictable cluster of stop losses. Their goal isn't to catch a little bounce. Their goal is to acquire liquidity. They need to find enough sellers to fill their own massive buy orders. And where's a guaranteed pool of forced sellers? Right where all those stop losses are.
This leads to a classic and pretty brutal maneuver called a stop run. It's a simple three-step process. First, they locate that dense cluster of stop losses just below the obvious indicator level. Second, they use their market power to briefly shove the price through that level, triggering all those automated sell orders at once. And third, as that flood of forced selling hits the market, they're on the other side, quietly absorbing it all to fill their own huge buy orders at a much better price. The retail trader's pain becomes the institution's gain.
So, how do we use this information? How do we avoid becoming somebody else's liquidity? Well, Section 5 is all about making a crucial shift in perspective. We have to stop trying to predict the future and start reading the scoreboard of crowd behavior.
Think of it like this. The old model is predictive. It constantly asks, where will the price go next? But this new, reactive model is way more powerful. It doesn't try to forecast price. It tries to forecast crowd behavior. It stops asking where will price go and starts asking the institutional question, where is the liquidity?
And if there's one thing you take away from this entire explainer, let it be this. The indicator is the scoreboard, not the game itself. It doesn't tell you who's going to win. It tells you where the crowd is positioned, where they're likely to feel pain, and where they are most likely to act.
So that leads to your new mission. Your goal is no longer to trade the map itself, to just blindly buy when the RSI is oversold. No, your goal is to trade the institutional reaction to the map. You wait for the stop run, you watch them sweep the liquidity below that key level, and then you look for your entry. You're not following the herd anymore. You're following the wolves.
So I'll leave you with this final thought. Technical indicators do work, just not in the way most people think. They are a map of crowd psychology. So the most important question you can ask yourself the next time you look at a chart is this. Are you reading the map, or are you just another location on it for someone else to find?